January 30th, 1992. The SEC signed off on a letter. That letter destroyed a Fortune 10 company. On that date, regulators approved a single accounting request from Enron Corporation. The company wanted permission to use mark-to-market accounting for its natural gas trading contracts. The SEC said yes. Within a decade, Enron would become the largest bankruptcy in American history, wiping out roughly $74 billion in shareholder value. And the accounting method the SEC approved that day? It remains perfectly legal. This is not a story about criminals breaking rules. It is a story about what happens when the rules themselves become weapons. Enron was formed in 1985 when Kenneth Lay merged two pipeline companies. For years, it operated like any utility. It owned pipes. It moved gas. The accounting was straightforward. Record the cost of buying gas, record the revenue from selling it, report the difference. Simple. Then Jeffrey Skilling arrived. Skilling had been a McKinsey consultant, and he saw pipelines as a dead business. The future was trading. Instead of moving molecules, Enron would move contracts. It would become the middleman for American energy, taking a cut on every deal. But trading created an accounting problem. Traditional accounting made traders wait. If you signed a 20-year contract to deliver natural gas, you could only book revenue as you actually delivered the gas, year by year. Skilling found that intolerable. He wanted to book the profit immediately, the day the contract was signed. Mark-to-market accounting let him do exactly that. Under this method, you estimate the entire future cash flow of a contract, discount it to present value, and record that number as profit on day one. The SEC granted Enron permission to use this approach for its gas trading in early 1992, making it the first non-financial company approved for the method on long-term contracts. On paper, the logic was reasonable. Banks used mark-to-market for securities that traded in liquid markets with observable prices. If you held treasury bonds, you could look up the price any minute of any day. Marking them to market just meant being honest about what they were worth. But natural gas contracts were not treasury bonds. Many of Enron's deals stretched 10 or 20 years into the future. There was no market price for a contract to deliver gas to a power plant in 2015. Enron had to estimate the price, and the company that made the estimate was the same company that reported the profit. Here is where the mechanism turned toxic. Skilling tied executive compensation to stock price. The company installed stock tickers in lobbies and elevators. At budget meetings, he would ask what earnings were needed to keep the stock price up, then tell managers to hit that number. By December 2000, Enron had roughly 96 million shares outstanding in stock option plans, about 13% of common shares. Executives were sitting on hundreds of millions in potential gains. Mark-to-market gave them a printing press. Sign a contract, book the profit. The viability of these contracts and their related costs were difficult to estimate, but nobody outside the company could check the assumptions. Enron could project optimistic gas prices, optimistic volumes, optimistic margins, and report the rosy total as immediate earnings. The problem was sustainability. Once you book year one profit on day one, you cannot book it again next quarter. You need new deals, bigger deals, constantly. One competitor described it clearly. If you accelerate your income, you have to keep doing more and more deals to show the same or rising income. Enron found those deals. Between 1996 and 2000, reported revenues rose from roughly $13 billion to over $100 billion. That is growth of more than 750% in 4 years. The company climbed to 6th place on the Fortune Global 500. Fortune magazine named it the most innovative large company in America for 6 consecutive years. But the cash was not keeping pace with the paper profits. Mark-to-market let you book revenue you had not collected. It did not let you pay vendors with imaginary money. Enron needed to hide the gap, and it found the tool in special purpose entities. These were shell partnerships, technically separate from Enron, funded with a sliver of outside equity and a mountain of debt. Accounting rules at the time allowed companies to keep these vehicles off the balance sheet if certain conditions were met. Enron pushed those conditions to breaking point. Andrew Fastow, the chief financial officer, created a web of these structures. Some had names from Star Wars, Chuko, Jedi. Others were named after Jurassic Park, the Raptors. By 2001, Enron had used hundreds of special-purpose entities. Collectively, they hid billions in debt and billions in losses on failed projects. The Raptors alone received more than $1.2 billion in Enron assets, including millions of shares of Enron stock. Enron used that stock as collateral for derivative contracts that hedged losses in its investment portfolio. But if Enron's stock fell, the hedge collapsed. The company was hedging itself with its own paper. For years, the auditor signed off. Arthur Andersen earned roughly $52 million from Enron in 2000, split almost evenly between audit fees and consulting fees. The Powers Committee, appointed by Enron's board, later concluded that Andersen did not fulfill its professional responsibilities. Andersen's Houston office overruled critical reviews from partners in Chicago. When the scandal broke, employees shredded documents and deleted nearly 30,000 emails. The first public crack came in March 2001. A Fortune reporter named Bethany McLean published an article titled, "Is Enron Overpriced?" She had been tipped by a short seller named Jim Chanos, who had read Enron's annual report and noticed the company was spending vast amounts of capital while its broadband unit somehow outperformed a struggling industry. McLean called Skilling for comment. He called her unethical for not properly researching his company. By summer, cracks widened. In August, Skilling abruptly resigned as CEO after just 6 months. He cited personal reasons. Observers noted he had sold at least 450,000 shares in the preceding months for roughly $33 million. 2 weeks later, a vice president named Sharon Watkins sent an anonymous letter to Kenneth Lay warning that the company would implode in a wave of accounting scandals. October brought disclosure. Enron announced restatements to its financial statements from 1997 through 2000. The corrections reduced reported earnings by $613 million, roughly 23% of profits during that period. Liabilities increased by over $600 million. Equity dropped by $1.2 billion. The SEC opened a formal investigation. The stock, which had traded near $90 at its peak, fell to $20 by late October. Credit rating agencies threatened downgrades. If Enron fell below investment grade, it would trigger guarantees embedded in its debt agreements, accelerating billions in payments the company could not make. Denergy, a Houston competitor, offered a lifeline. On November 8th, the two companies announced a merger valued at roughly $8 billion. Denergy would inject cash. Enron would survive. But due diligence revealed horrors. Enron's new treasurer discovered that the company had been operating quarter to quarter, with no procedures for tracking cash or debt maturities. Under Fasto's watch, Enron had failed to develop the basic financial controls common at firms of its stature. For all intents and purposes, Enron was illiquid. On November 28th, both Moody's and Standard & Poor's cut Enron's credit rating to junk. Denergy's board pulled out of the merger. 4 days later, Enron filed for Chapter 11 protection, with $63.4 billion in assets, the largest corporate bankruptcy in American history, until WorldCom the following year. Nearly 62% of Enron's 15,000 employees held retirement savings in company stock. Those shares, worth $83 in early 2001, were now worthless. Employees lost roughly $2 billion in pension value. Shareholders lost $74 billion. A class action eventually recovered about $7.2 billion from banks and other defendants, roughly 18 cents on the dollar. The legal aftermath was severe. Fasto pleaded guilty to 2 counts of conspiracy and was sentenced to 10 years. He served 6. Skilling was convicted of 19 counts of securities and wire fraud and initially sentenced to more than 24 years, later reduced to 14. Lay was convicted on all counts but died before sentencing. Arthur Andersen was convicted of obstruction of justice for destroying documents. The conviction was later overturned by the Supreme Court, but by then the firm had already dissolved, putting 85,000 people out of work. Congress responded with the Sarbanes-Oxley Act, imposing stricter audit rules and executive certifications. But mark-to-market accounting was never banned. The SEC still permits it for instruments with observable market prices. The definition of observable remains subject to interpretation. The mechanism Enron exploited was not illegal. It was approved in writing by regulators. What Enron did was take a flexible standard and stretch it until it became fiction. No external auditor stopped them. No rating agency demanded clarity. No regulator revisited the 1992 approval as Enron's contracts grew more complex. The lesson is structural. When an accounting rule lets management choose its own assumptions, and when those assumptions drive the bonuses of the people choosing them, the incentive to be optimistic becomes almost irresistible. Enron did not fail because a few executives were greedy. It failed because the system gave greed a compliant architecture. That architecture still exists. Thanks for watching. If this was useful, hit subscribe and turn on notifications. Sources for everything you just heard are in the description.